Hi, this is Vandana Hari from Vanda Insights in Singapore, coming to you on the 13th of April 2020. There was a landmark OPEC non-OPEC production cut deal signed yesterday. What does this mean for the oil markets? Let me share my views with you by answering 5 key questions. First, what is this agreement? OPEC and non-OPEC have pledged to slash their output by 9.7 million barrels per day over May and June this year. The deal actually goes all the way out till April 2022, but the reduction is expected to taper. So it is planned to ease to about 7.7 million barrels per day through the second half of this year and to 5.8 million barrels per day from January of next year to April 2022. There was a compromise reached with Mexico. The non-OPEC ally had been holding out and holding up the finalization of this deal, refusing to accept its prorated cut of 400,000 barrels per day. So finally, the compromise is that Mexico will cut by just about 100,000 barrels per day. Curiously, the US has offered to reduce its own production by an additional 250,000 barrels per day to make up for the difference in Mexico's numbers. However, given the fact that the US is not even mandating any cuts at home and simply relying on an expected natural decline in its output, it remains to be seen how that works out. What is the actual size of the planned cut? It's not 9.7 million barrels per day for the next 2 months. You see, the baseline for the cuts is October 2018. What that means is that the reduction that OPEC, non-OPEC implemented through 2019 and then some more through the first quarter of this year is being double counted. Effectively, a back of the envelope calculation shows that compared with their March production levels, the producers are pledging to reduce by about 8.5 million barrels per day over the next 2 months. Now, are there any other producers joining this OPEC non-OPEC combine? The short answer to that is no, not in the sense of mandating their own cuts. So of course, US, Canada, Brazil, Norway are all expecting declines in their output. However, it's important to bear in mind that none of these countries has actually pledged a certain number. OPEC, non-OPEC are expecting and hoping rather that combined output decline from these countries will add another 5 million barrels per day of supply reduction. Now, what has been the reaction of the markets this morning? Clearly, the oil market is a bit underwhelmed by this agreement. When crude futures opened to trade on Monday morning after the Good Friday long weekend, there was quite a bit of volatility, and initially the prices traded on either side of Thursday's close. In the next few hours through the Asian morning, they had calmed down a bit to trade about 4 to 5% higher than Thursday's closing levels. Now, what can we expect going forward? Very clearly, the market will focus on compliance. The market will need to see the OPEC, non-OPEC members starting to pare back this month itself, because it's not easy to switch off, as it were, 10 million barrels per day of production overnight. The market will also be looking to see if any of those other non-OPEC producers that had pledged to work with OPEC will actually come forward by committing to cuts. In the absence of that, we don't expect to see a major upward push to oil prices. That could happen if and only if demand starts recovering with the end of the coronavirus pandemic. As of now, when that happens and at what pace that happens is anyone's guess. Thank you for tuning in. Goodbye.